Have you ever looked at your finances and thought, there has to be a better way to invest my money without becoming a stock market wizard? Many of us feel that way. We know investing is crucial for building wealth, but the sheer volume of options can be overwhelming. That's where robo-advisors come in, automated platforms designed to make investing accessible and straightforward. Today, we're diving deep into two of the most popular names in the robo-advisor space, Acorns and Fidelity Go. This isn't just a surface-level comparison. We're going beyond the basics, dissecting their features, fee structures, investment philosophies, and even their tax efficiency and customer support, to give you an advanced breakdown that will help you decide which platform truly aligns with your financial goals. Understanding the core philosophy, Acorns micro-investing versus Fidelity Go's traditional approach. Let's start by understanding the fundamental difference in how these two platforms operate. Acorns has built its brand around micro-investing. Their flagship feature, roundups, automatically invests your spare change from everyday purchases. Buy a coffee for $3.75, and Acorns rounds it up to $4, investing that 25 cents difference into your portfolio. This approach is brilliant for behavioral finance. It makes investing feel effortless, almost invisible. It's designed to appeal to those who struggle with saving or are intimidated by traditional lump sum investing. The idea is that these small, consistent contributions add up significantly over time thanks to the power of compound interest. Acorns also encourages recurring investments and offers found money, cashback rewards from partnered brands that get invested directly into your account. This micro-investing philosophy is fantastic for cultivating a habit of saving and investing, especially for beginners or those with limited disposable income for large, regular contributions. Fidelity Go, on the other hand, takes a more traditional robo-advisor approach, albeit with the backing of a financial giant. While it allows for recurring deposits, its core appeal isn't about rounding up spare change. Fidelity Go focuses on building diversified portfolios using their proprietary Fidelity Flex mutual funds, which notably have zero expense ratios. This means you're not paying underlying fund fees in addition to the advisory fee. Fidelity Go emphasizes a clear, goal-oriented investment strategy where you answer a series of questions about your financial goals, time horizon, and risk tolerance, and the platform constructs and manages a portfolio tailored to your responses. It's designed for those who want a hands-off, professionally managed portfolio without the complexities of self-directed investing. Fee structures, where every dollar counts. When it comes to investing, fees are a silent killer of returns. Understanding the fee structures of Acorns and Fidelity Go is paramount, as they differ significantly. Acorns operates on a subscription-based model with tiered monthly fees. As of mid-2025, their pricing generally looks like this. Acorns Personal, $3 per month. This typically includes an Acorns Invest, taxable brokerage account, Acorns Later, retirement account like an IRA, and Acorns Checking, a checking account with a debit card. Acorns Personal Plus, $6 per month. This tier often adds features like an IRA match on new contributions, e.g., 1% during the first year, and potentially higher APY on checking and savings. Acorns Premium, $12 per month. This highest tier usually includes all the features of the lower tiers, a higher IRA match, e.g., 3% during the first year, and the ability to invest in individual stocks. It also typically includes a custodial account for kids, Acorns Early, and some basic financial planning tools. The key takeaway with Acorns fees is that for smaller balances, the monthly fee can represent a significant percentage of your assets. For example, if you have only $100 invested in Acorns Personal, paying $3 a month is equivalent to a 36% annual fee, which is extremely high. As your balance grows, this percentage shrinks, becoming more reasonable. This model incentivizes larger balances to dilute the impact of the fixed monthly fee. Fidelity Go takes a different, often more favorable, approach for larger balances. They have a tiered advisory fee structure. Accounts under $25,000, free. Accounts $25,000 and over, 0.35% annual advisory fee. This fee structure is highly competitive, especially for those with under $25,000, as you pay absolutely nothing for portfolio management. For balances above $25,000, the 0.35% annual fee is still very reasonable compared to many traditional financial advisors who might charge 1% or more. Moreover, as mentioned, Fidelity Go uses Fidelity Flex funds, which have zero expense ratios, eliminating another layer of fees. This means the 0.35% is effectively your total annual cost for investment management. From a fee perspective, Fidelity Go is generally the clear winner for accounts with balances over a few $100s. The free tier for balances under $25,000 is a significant advantage, and the 0.35% for larger balances is highly competitive. Acorns' fixed monthly fee can be quite punitive for small portfolios, making it less cost-effective until your invested capital reaches a substantial sum. Investment strategies and portfolio options, diversification and customization. Both platforms aim to provide diversified portfolios, but their underlying investment vehicles and customization options vary. Acorns primarily invests in portfolios comprised of low-cost exchange-traded funds, ETFs, from major providers like BlackRock. When you sign up, you answer a risk tolerance questionnaire that helps determine one of their 5 core portfolio options, ranging from conservative to aggressive. These portfolios are typically diversified across U.S. and international stocks and bonds. While Acorns doesn't offer extensive customization at its lower tiers, their premium tier allows for some individual stock investing, giving users a bit more control if they desire it. Acorns also offers ESG, environmental, social, and governance-focused portfolios, allowing investors to align their investments with their values. Some reports also indicate Acorns offers exposure to Bitcoin futures ETFs for those interested in a sliver of crypto exposure. With that said, thanks for watching, and until next time.